Hello and welcome to part two of the common fears and concerns that hold people back from getting started in property development. In the last module, we talked about fears and we also talked about the number one reason, which was cash. And in this module, we're going to cover the next three issues that people throw up as reasons why they don't get started in property development. And that is being able to determine the viability of a project, finance more broadly across a development project, and the risks associated with doing property development. So let's take a look at each of those. So the second fear that people often say to me is around how do I even determine whether it's worth doing a project? Because people don't know what they don't know. And what that means is, well, what do you actually include in a feasibility? How can you do a feasibility study for a project when you don't even know what numbers to include? And that's completely understandable. So in a development feasibility, there are three really big numbers: the purchase price of the land, the end sales prices of the newly built and finished dwellings, and the build cost to build those new dwellings. And all of those can be determined with some good research. And there's a whole bunch of other costs that you need to include that can make a difference. And some of them are often omitted by people because they don't know that they need to put them in. And that might be things like contributions for sewer or water, electricity, or taxes that will have to be paid on any profits along the way, or GST that has to be paid depending on how you structure your project. So there's lots of numbers that go into a feasibility. And a feasibility is obviously very important because it's the key that you use to determine whether a project is worth doing. It gives you confidence to go ahead. So the feasibility is the linchpin for any project because it is the starting point for deciding whether it's worth pursuing or not. It also helps to show when you're going to need cash along the way, which we've already talked about. So let's have a quick look at a feasibility template so you can see what kind of information you need to put into a feasibility. So here's a feasibility on a mythical project. And you can see up the top we've got the income, which is money that comes in, and then the expenses, which is all the money that goes out. So in this project, we've got nearly $2 million in income or revenue, the biggest part of which is the sale of our new units, which is called the gross realization value. And then down the bottom, we've got all the expenses, and there's a lot of them in development, and they total up to about 1.5. So we get net profit of nearly $400,000, which is a margin of 25%. You can see the total development cost figure here of 1.5. We've already touched on that previously when we were talking about lending. And then another important number is your gross realization value, which is the total value of the sales of your new stock. So all these lines here have a lot of numbers behind them, which are project costs. And you can see here all the various costs that make up those line items. So there's lots of them that are there, but you can go away and find all these numbers with a little bit of digging and persistent research. And so they're the numbers that you need for your feasibility. And then you can also prepare a cash flow spreadsheet, which then shows when you're going to need all the cash. So as you can see in this project, there's quite a lot that happens here in this first section, which is when you're doing all your planning and preparing. And then as the project unfolds, you've got other money that needs to be paid along the way. So you can see how the cash flows through the project. Obviously at the beginning you have a big chunk, and then along the way you have other payments that have to be made. So doing a good feasibility will give you confidence to go ahead with a project. And in the property developer training, I go through how to prepare a financial feasibility and how you can get these numbers together because it's such an important part of a development project. So following on from conducting a feasibility, you then come to issue number 3, which is finance more broadly related to property development. And it's a bit of a mystery for people who've never done a project before, and that's understandable because property development funding is different to residential funding, where you generally will have longer terms. If you're buying an investment property, it might be over a 20, 25, 30-year loan term, and it's looked at very differently by the bank. Whereas with property development, you're looking at 2 key stages for funding. The first is the funding related to the purchase of the site. And then the second big part is related to the construction funding, so the money to build the new units. So initially you might purchase a potential development site as an investment property using standard investment type loans, and they're probably not too much of a mystery to you. But when it comes time to build the new dwellings, you'll obtain construction funding. And this is a very different type of funding and will be influenced by how much you need to borrow. Now, the reason why it depends on how much you need to borrow is because sometimes if it's only up to about $1 million, the bank might actually treat it as a residential loan, and they'll be looking more at serviceability, which means can you actually pay back the loan? If you're looking for more than that amount of money, it might be treated as a commercial loan, and then the bank looks at it very differently. They look at it more through a commercial lens. So they want to look at the project feasibility and the applicant, the sponsor, the person who's making the application for the loan. And with construction funding, banks often look for debt cover with these kinds of loans, which means if you want to borrow $1 million, they'll want $1 million in pre-sales to cover their debt and reduce their risk. So if you were doing a 4-unit project and each of the new units when they were finished were going to be worth $500,000, the bank would want you to pre-sell 2 of those to cover off their debt before they would then release the construction funding. Another key point to note is that interest and other costs are often capitalized, which means it gets added to your loan along the way and then all paid back when the loan gets settled at the end, when you settle your new properties and they get taken over by the new owners. So that's a little quick summary of how finance works in property development. A good broker is essential when you're doing a project because they're not all created equal. And construction funding is very different to residential funding. So you really want someone who knows what they're doing in that section of the funding market. And a really good broker will be able to guide you through that process and give you an idea of the kind of terms and conditions that various lenders will set for you. Okay, let's take a look at risk, because people often say they're worried about the risk involved in doing a development, and that's completely understandable. But there's risk in every business that you do, and managing risk is just an essential part of developing. But I have found that having a great team around you helps with risk. It helps with identifying and it helps with managing that risk. So what are the different things that you can do to mitigate that risk of happening? Now, the good part about property developing is that we know what a lot of the risks are that we're likely to face. And you can break them down based on each stage of the project. For example, profit risk. Is the project going to make the kind of profit that you think it will? And that all comes down to doing a really great due diligence and making sure that your feasibility is done really well. When you get into the planning phase, the planning risk, what's the likelihood of getting your permit? Well, again, if you do a really good area analysis, you can figure out whether you're likely to get a permit or not. If you're trying to do something really strange that's never been done before in that area, well, you might be taking on something very risky. Then we look at the market risk for selling your new product at the price that you think. Well, you look around at all the other products that's for sale in the area and you can determine whether you're being realistic or not. Same with the sales risk. Are you going to be able to sell them for the price that you think you are? Well, you can look at the local market to determine that. Construction risk, about getting things built for the price that you think they're going to be built for by a good builder. Well, you can have a very stringent selection of the builder. That's a way of reducing the risk in that element of a project. Then we look at settlement risk. Will people actually settle on the off-the-plan sales that they've made? Well, if you're going with local buyers with a 10% deposit, well, that can help reduce the risk of settlements not happening because local buyers with 10% deposits tend to settle. And then finance risk. Will you be able to get the money that you need to do your project? Well, we've just talked about having a broker help you identify what kind of terms and conditions lenders might impose to let you borrow money. So there's lots of things that you can do to identify risks, and there's lots of steps that you can take to mitigate them. I found that one of the best things you can do is have a really good team of people around you. And you can leverage their experience and knowledge to ensure that bad things don't happen during your project. Okay, that brings us to the end of part 2 in this 3-part series around the issues and concerns that hold people back from getting started in property development. This time we looked at determining project viability to give you comfort around whether a project is worth pursuing or not. We talked about finance more broadly and how it's a bit different than standard residential funding. And we talked about property development risk, how you can identify the kind of things that are likely to happen along the way and the things that you can do about it. In the next and final module, we'll look at the things that you can do to get started in property development, if that's something that you'd really love to do. So I look forward to you joining me then.